Okay, let's look at the second contract now. Okay, the second one. Now, this is the same thing, but we've twisted the questions a bit and we've changed the scenario. Okay. 1 second. I need somebody to volunteer to do this question with me. Okay. Who wants to do it? Okay, Sohail Furia. You're new in my batch. I've never seen you before. This is your first term. Would you want to try it? No? Yes? Okay. Let's see what's happening. There is an asset which is a useful life of 5 years. And there was an option given to the lessee to purchase the asset at the end of the lease term, which the lessee is most likely to exercise. The value of that purchase option is $15,000. The lease term is for 3 years. There has to be a payment of $100,000 that will be made annually for the 3 years. So 3 years, and each payment will be made on 31st December. So the moment I know this, I know I'm going to use the PV of ordinary annuity for 3 years. Yes or no, guys? Is this clear? So 3 payments are going to happen at the end of each year. So year 1 discounted, year 2 discounted, year 3 discounted. So we have got to take the PV of $100,000 that will be paid at the end of each of the years. And it's an annual contract. They tell you that the rate implicit in the lease is 10%. But if you look at the lessee's incremental borrowing rate, it is 15%. They've told you that the carrying value of the machine in the books of the lessor is $250,000. And the day when the lease is commencing, on that day, the fair value of the machine is $259,995. Okay, the first question, guys. Just attempt it. What kind of a lease is this? What kind of a lease is this? Yes? What kind of a lease is this, guys? Finance. And why do you say that? Why do you say that this is a finance lease? Because there's an option to purchase, right? So the O of STOPS is being met. The moment an O is met, I know it's a sale type lease for the lessor and the finance lease for the lessee. 1 second, guys. Okay. So what is the PV of minimum lease rentals? Rahul Bose. Rahul, do you want to do this? What is the PV of minimum lease rentals? Rahul Bose. Rahul, do you want to try? Okay, guys, please. If you don't want to answer, just raise your hand and keep it raised throughout the session. We'll not waste our time in asking for you to come ahead and answer. Vishnu, do you want to give it a try? Okay, no problem. Just raise your hand, Rahul, and keep it raised throughout the session. Okay, Vishnu, what is the PV of the monthly? So what is the monthly installment? Tell me.
1 lakh into
100,000. Okay.
Yeah.
And what is the PV factor that we're going to take?
It is 10. I mean, what's the interest rate effective? So 10%, right, ma'am?
To take 10%, because that's the first thing that you're going to take. If they give you the rate implicit in the REIT, you will take that. Only if that is not there, then you will take the in lessee's incremental borrowing. So PV factor will be of an annuity of 2.4685. Agreed?
Yes, ma'am. So 1 lakh into 2.48,
which is okay.
Yeah.
What is the bargain purchase option, PV?
15,000
into
10% at the 0.75130.
So you will take it for $1 because this is one figure. Oh,
at the end of. Yes, ma'am.
Okay, yeah, 1 second. Somebody just joined us. Is this clear? So we take PV of the bus. So what is the PV of total lease rentals? Can you see this is the amount that is guaranteed by the lessee? If nothing else is given, assume it is guaranteed by the lessee. So ideally, the total amount of payment that will flow to the lessor is
P18.
is actually, is actually 2,15,000. Can you see this is the fair value? So basically, this is also a finance lease because 100% of the PV is equal to the fair value of the asset. Yes or no?
Correct. Yeah.
So basically 10% is the rate implicit in the lease. Can you understand that now?
Yes.
Because this is the rate at which the PV of the receivable is equal to the fair value of the asset right now. What is the interest rate that we're going to take?
10%.
For the calculation purposes? 10%. Thank you. Is this clear? Everybody, is this clear? So what we're doing, we're taking the PV of the lease payments right today on the day 0. What will be the total value of the payments that will move on from the lessee to the lessor? We're taking the PV of that since it's a sale type lease for the lessor and there is a finance type lease for the lessee. Our accounting treatment will differ. Okay, so we'll work out the effective interest method, guys. Who wants to do it with me? Okay, Jasmeet, your hand is raised. Tell me. You don't have this sheet, right? 1 second, let me just rename it. Okay, not. Jasmeet, you have a question, just write it in the chat panel. Joined. Okay, Anita, unmute. Chalo, let's do this together, okay? So tell me, what is the lease liability at the beginning of the period?
259,955.
So this is the figure that the lessee is supposed to pay to the lessor, okay? So the first year, see there are 3 payments, right? 100,000, 100,000, 100,000. You're going to break it into principal and interest and the basically effective interest method. Is that clear? So what is the rate of interest that we'll assume?
10%.
10%, right? So we'll take 10%. So what is the interest? On the beginning PV,
Yeah,
apply
259.
10%.
Right.
This becomes my interest expense. How much is the total money that I'm paying?
Total money is installment, right?
Yeah,
Like,
100,000, right?
yeah.
So typically out of $100,000, my interest is 25,995 and I'm paying the principal of 74,005. Is that correct?
Right.
So what is going to be my, so basically my ending lease liability, I'm supposed to pay you 259,995, right?
Right.
Oh, okay. So my ending lease liability becomes how much?
259,995 minus 74,005.
So typically at the beginning of the year, I started with a liability of 259,995. I was supposed to pay you interest at 10%. That means my interest stands at 26,000 or something. But I'm paying you 100,000. That means the balance I'm reducing from my lease liability. And at the end of the tenure, my lease liability becomes 185,950. Is that clear?
Right. Yeah.
Second. Okay. We have one more person who will try the next one for us. Okay. Please
I can
unmute
try.
yourself. Yes. Who is this? Sharad. Hello, Sharad. Let's do
Yes.
it together. Tell
Okay.
me, for the next one, what will be my opening liability?
185,950.
Very good. Interest factor remains the same, right?
Yes.
Amount remains the same. Sorry. Okay. This I have not exposed. 1 second, 1 second. Yeah, so this actually becomes frozen figure.
Yeah, I'm also facing the same.
No, it's okay. No, we press a lot of stuff. Just freeze this figure, right? Yeah.
Yes. 81,405. Yes. It is the
Okay.
same.
Is this clear? Everybody, is this clear? So ideally, can you see this is your interest expense? And this is your entire lease liability that will get 0 at the end of the lease. Oh, tell me what is the mistake? Quickly tell me what is the mistake, everybody? Why is this not tallying? Can anybody tell me? What error we have made? This should ideally come to 2,59,990. See, in the end of the period, I'll have to pay 115,000. Is that clear? This has to include your purchase option, bargain purchase price. Is that clear? Guys, 1 second. I think there is problem. Okay. Is this clear, guys? So what is happening? I'm booking right now a PV of all my rental payments at 259,955. Every year, I'm going to take 10% interest on opening liability. That becomes my interest component. The balance will be my reduction of lease liability. At the end of the entire 3 years, my lease liability will come down to 0. Anybody, any questions? Anybody, any questions so far? Now see, this will really work out easy because this is exactly what we did in notes payable and in bonds. What we do, we bring in the leased asset in our book at the entire opening value, and we will bring in the lease liability in our books at the entire opening value. Guys, you're doing this together with me, right? So at the beginning of the lease term, now this is a finance lease. So I bring in the leased asset and I bring in the long-term liability in my books. In the first year, when the first payment is being made, that entire 1 lakh, I will break it down into interest and the reduction of liability. And I will pay you the full amount of $100,000 in cash. You see this? Now, the asset that I have in my books. Now, this is a chocolate question, guys. Think and answer. What should be the amortization expense in the first year for the ROU asset in our books? It is a straight line method of amortization, okay? It is a straight line method of amortization. Can anybody tell me what is the amortization amount that I should debit in my books? This is a chocolate question. Let's see who answers this first correctly. What is the value of amortization? If I tell you that the amortization happens on a straight line basis, can you tell me what is the value of amortization expense that I should put in my books here? Can anybody tell me what is that figure? I want everybody to try this. No, I want the figure, Anita. Don't give me what you think. Just give me the one. I'll just see one figure. I want the figure. I want the figure, guys, okay? And I want everybody to try. We don't have a lot of people here, but whoever are there, I want everybody to try. I want to know. What do you think can be the figure? Yes? Anirban, Orgo, Jasmeet, just write me the figure. Prateek. Are very good. Sharad, come tell me, what is the figure?
51,991.
How?
The total value that was 259,955 divided by the useful life, which was 5 years.
Why will I not take 3 years and will I take 5 years?
It's a lease term. The actual life of the asset is 5.
Very good. Is this clear? It is not 3 years, guys. Okay. When you're planning to buy the asset at the end of the lease term for additional 2 years, when you're depreciating it, you're going to treat it like you didn't you see that? Even when you took the PV, you took the PV of that entire 2 years, that amount of, so what are you going to assume? That I'm going to buy the asset at the end of 3 years, the asset is going to become mine. And I took the PV assuming that, right? So why will I depreciate it over 3 years? We will not. Is that clear? So when the ownership criteria is going to be met, which is either title is going to be transferred or the bargain purchase option is going to happen, I'm going to depreciate it over the entire useful life of the asset. When the other 3 criteria, the specialized, is that clear? Useful life, okay. Anita, bad luck. Questions are going to be tricky. And then nobody's going to get into you to know how much you've understood. Is this clear? If the T and the O options are met, we're going to treat the asset as if it is yours right away, and you're going to depreciate it over the entire tenure of the asset. Only in scenario where the finance lease is classified because of either the P criteria or the last S criteria or the first S criteria, I'm going to treat it over the leased term. So in this case, can you understand, guys? The useful life of the asset is 5 years, but the term of the asset is actually 3 years. Is this clear? So in my example, I'm going to depreciate it over 5 years and not 3 years. Right? Okay. Another question. Let's see who answers this. What is the current liability, if any, that the lessee is going to report in his books at the end of the first year? Do you think there is any current liability that the lessee will report at the end of the first year? If yes, how much? Anybody? Very good. And what is the non-current liability? Very, very good. Okay, Vishnu, unmute. Explain. In the balance sheet, now can you understand what is happening? In the P&L, I have hit the interest expense and I've hit the depreciation expense. Do you understand this? I've treated the interest and the depreciation separately and I've booked it separately, unlike the operating lease. Okay. Now in the balance sheet, I had an ROU asset, which I bought at 259,995. I have a liability, which was long-term. But after the first year, I'm going to reclassify that liability as short-term and long-term. Vishnu, explain and tell me the figures that will move it. Tell me.
So the next due, the due amount in the next 1 year will be classified as the current liability, the balance of
Which is, in my example here,
81,405.
so this liability is due immediately next year. So the part of the liability that is due in the immediately next current year, I'm going to classify it as a current liability, and the part that is in excess will treat it like a long-term liability. Okay, and what is my ROU asset? My balance sheet ROU asset will become the entire 259 minus the amortization that I've already booked in my books. Is that clear? Anybody, any questions? Is that clear? Now see, the next one becomes easy right now, okay? Now there's no problem. The next year again, I'm going to book the interest element. I'm going to principal element for the lease liability reduction. I'm going to book the entire amount of payment that I'm going to make. I'm going to amortize it exactly the way I did earlier. Amortization is straight line, okay? Next year, my current liability portion will become full 1,04,000 and there will be no non-current liability in my books. The ROU asset, okay, the ROU asset will become this minus the amortization again. Isn't it, guys? The third year, again, I'll do the same thing. Just finish this table up on your own. So I'll start with this. The lease liability will now go down by the element of this. Here, just remember that when I pay you 1,15,000 and not 1 lakh, okay? Now I've got the asset in my books. The amortization will be exactly the same as I did earlier. Is that clear, guys?
Yeah, so D49 will be 81,000, right?
D49. No, why? Oh, sorry. I think I've taken the wrong. Yeah, 81,405. Yes, sorry.
Yeah.
Yeah. Okay. Do you realize what's going to happen at the end of everything? At the end of the last year, you will still have 2 installments for amortization left, right? Now you're going to reclassify the ROU asset and you're going to convert it into a formal asset in your books, which is machine. Is this clear? So now you're going to reduce the ROU asset and finally book the asset as a machine in your books. Okay, is this clear, guys? Did you understand one thing? We are bringing in the asset and the liability. The asset is coming down in the amortization method. The liability is coming down in the effective interest method. Every year, we are dividing the entire payment into interest and the principal payment. The interest payment will come in my P&L. The liability payment will reduce my long-term liability in my balance sheet. And every year in the balance sheet, I will recognize the current portion of the liability and the non-current portion of the liability. Since this was see, understand, guys, this might change. There may be a guaranteed value by the lessee. Okay, in this example, it was a bargain purchase option. So towards the end, whatever is the balance lying in the ROU asset, you will convert it into machine. Is this clear? Anybody, any questions?
Shraddha, I didn't understand the last step, 10 machine to RU.
See, you have, the asset, the ROU asset will still remain. See, my total asset was at 259,995, right, Anita?
Right.
I depreciated it 5 years and I depreciated it for 3 years, isn't it?
Right.
Sorry, I don't know why. 1 second. I depreciated it for 3 years, isn't it?
Right.
So there must be some residual value that must be remaining in my books, isn't it?
Right.
2 years worth of value, right? Now there is no ROU asset because the asset has become yours, isn't it?
Okay, okay.
Now I will have to bring that asset, remove it from ROU and bring it. Just reclassify it as a machinery in your books.
Okay. Yeah, I got
Because
it.
now it's no longer an ROU asset, isn't it?
Yeah, because from the beginning, my mind had this, there is a 3-year life. So that's why I got confused. Sorry again.
No, it's a 5 years life, okay?
Yeah.
See, it can't get more complicated than this, by the way, okay? If this is what you've understood, then I'm pretty sure you'll be able to answer all the questions in this area.
Right. Yeah.
Clear? Okay. Now just reconstruct it from the lessee's perspective, lessor's perspective, guys. See, it is now the best part is here in sale type lease, you will get the exact mirror image of what is happening in the lessee's book. So what is happening here, guys? This, okay, forget about net investment. This is what you might get in certain examples, or just remember there is a asset that the lessor will record in its books. And let's call it asset or receivable, lease receivable account. Okay, in some books or in some situations, you can also refer to it as net investment in lease. The idea is an asset will be booked in the lessor's book and the machine will go away and there will be a gain on machine that will be booked in the lessor's books. Is this clear? So what is the journal entry? Who want to take it? Anirban, do you want to try this?
Yep.
Tell me,
Okay.
how much is the asset that will be booked in the books of the lessor? Receivable?
259,995.
Good. So the PV, the same figure that the lessee is going to give him, the lessor is going to get it as a receivable. Machine will go away from his books at what figure?
240. Wait a minute. Let me see.
The carrying value was 250, right?
250,000. Yeah.
And the balance will be,
Gain on sale. Yeah.
so this much he has gained because of the fact that he has sold the asset.
Right.
So this is L 34.
So it will be this minus.
Okay, forget it. This is this minus. Yeah, what's happening? But anyways, whatever is a delta will become the difference. Okay.
Yeah. 995.
So it's 999. I don't know what is happening. 999. Okay. Okay. What will be the interest element? Now this is now exact replica of this, right? In the lessor's book. So what will be
Yep.
the first entry for the gain? How much is he receiving?
100,000.
How much was the interest income?
25,995.
And the balance will be the liability reduction in his books. The receivable reduction, right? He's going to remove that receivable. Yeah.
Correct.
So it's the exact replica. What you're booking as a liability, the lessor is booking as a receivable. That asset will come down at the effective interest method. He will book an interest expense and he will book an interest liability, interest income. Thank you. Is this clear, guys? So see, it's easier for us to relate to this, isn't it? Every year, it's going to be the same thing. No delta. We are going to book a receivable, which is exactly going to be what is there in the lessee, in the lessor's book, in the lessee's book, right? There will be an interest element. There will be a reduction of the receivable in the books of the lessor. Okay.
Shraddha,
I'm
I
not
have a
convinced.
question.
Yes, Anita, tell me.
I have a question. Why are you taking it as a right to use asset, like ROU asset, when it's his own asset? So why can't we debit the asset?
For the tenure of the lease, we want the users, that's the reason you will not call it depreciation. You will call it amortization. We want the users to specifically know that it is a right of use asset because it is a leased asset. So even though technically I have put the lessee in the same position as he would have been had he purchased the asset, but during the tenure of the lease, I want the users of the financial statement to know that this asset has been taken on lease.
Oh, so we could have used the word leased asset, something like that. I don't know why we use
So that's the same thing. But
Yeah.
instead of calling it a leased asset, whoever was there at the helm of affairs, he liked the sound of ROU and he called it right
Okay.
to use. Right to
Okay,
use. It's the same thing.
that's little confusing, so that's why I asked you.
I will show you the Tesla's balance sheet and you will see where is the leased asset coming there. Okay, but the idea is to let you know that this is not the purchased asset and demarcate it. That is why they don't let you use the term depreciation. They call it amortization because they want you to differentiate the P&L and the balance sheet component for purchase versus the leased asset.
Yeah, I got it. Yeah. Okay, thank you. Yeah.
Okay, guys. Now I want some quick questions. Okay, answer. Think about it and answer. Look at the operating lease and look at the finance lease. Only from the lessee's perspective. Tell me what is the delta. Okay, tell me what is the delta between the operating and the finance lease from the lessee's perspective. Can you quickly tell me what is the delta? Okay, you're not recognizing the interest. Okay, anything else?
Amortization.
Very good. Explain how. See, ROU asset liability is coming at the same figure. Can you see this? He is also bringing the ROU at the discounted value. Even in operating lease, ROU came in the discounting value. Do you see the lease liability is also coming down to the exact same situation, right? The principal value from the effective interest table, we are bringing down the ROU, the lease liability exactly, isn't it?
Yeah.
The only delta is the amortization. What was happening? Tell me, what is the delta? Anirban?
The ownership is still with the lessor in operating lease. So the depreciation is with the lessor.
No. That's not the answer. Think.
I can try. We are bringing the RU asset down with the payment he's making, the less is making. The amortization, like it's not a straight line amortization as we did in.
Yes. Okay. Yes. See, understand the delta. Okay. See, Anirban, ultimately we are not calling it depreciation, but we are hitting the P&L with the depreciation figure, isn't it? P&L may this 30,000 that we are hitting with the lease expense, that is actually the depreciation and the interest, isn't it? We're just not calling it differently. So actually the P&L does not change. Can you see this?
Got it. Okay.
The only delta is in the finance lease, I'm calling it interest and amortization. In the operating lease, I'm calling it lease expense. But typically my P&L is not changing. Same with my liability. In both the cases, my liability is coming down by the amortization method. Do you see this?
Yeah.
And same here, effective interest method, I'm reducing the liability. The only delta is in the operating lease, the amortization, that means the asset in the balance sheet is also coming down by the effective interest method. But in the sale type lease, the amortization or the ROU asset is coming down on the straight line basis. Do you realize this, guys, everybody?
Correct. Yeah.
The only delta between operating and finance leases in the, so everything is the same, guys. Yes, exactly, Vishnu. We bring the ROU asset and we bring the lease liability at the PVs, both the cases from the lessee's book. Second, the effective interest method is used to bring down the liability in both the cases. Third scenario, the only delta is the amortization of the ROU asset. In the operating lease, we do it as per the effective interest method. In the finance lease, we do it as per the straight line method. And in the finance lease, there is the option of seeing whether the ownership or the title is getting transferred or the bargain purchase option is there. Then the tenure will increase, which is never the case in case of operating lease.